Good afternoon, everyone, and welcome to our discussion today on the Amazon effect, logistics real estate in COVID, kindly sponsored by Manry Logistics Fund. My name is Joseph Morris. I work in Cantor Fitzgerald's real estate capital markets business based here in the Middle East, and I'll be moderating today's session. For this discussion, we have an audience from around the world. I think we have participants from nearly 35 countries dialed in, so we really appreciate you taking the time to join us. Logistics is no stranger to outperformance. It's been a favoured asset class by real estate investors for a number of years now, and its returns have reflected this. As we move through the pandemic, it's a sector whose model has shown incredible resilience and real growth also. So during today's session, we'll be looking at the sector, its past and present performance, accessibility to it via public and private markets, its characteristics, and the continued demand from drivers from both occupiers and investors. So the format of today's session will be a short presentation from each of our participants, following which we'll have a Q&A. So please do participate, raise any questions that you may wish through the Q&A box in the corner, and I'll do my best to get through these towards the end of the session. I'm lucky enough to be joined by two individuals who are exceptionally well versed in this sector, the first of which I'll introduce now. Dr. Richard Barkham. Richard is Global Chief Economist at CBRE. He's one of the world's leading real estate economists, based in Boston, and his role leads a team of 700 researchers worldwide, whilst traveling and speaking extensively on key real estate trends. He has numerous academic and trade press publications to his credit, including a highly regarded book called Real Estate and Globalization, which deals with the impact on real estate markets of the rise in emerging markets, such as Brazil and China. He is also chairman of CBRE's Econometric Advisors, a specialist real estate forecasting unit. He is a visiting professor of economics at the Bartlett School of Architecture at University College London and holds a PhD in economics from the University of Reading. So without further ado, we'll kick off with our first speaker, Dr. Richard Barkham.
Thank you, Joseph. Let me just share my screen. Okay, so global industrial and the Amazon effect. Let's have a look at the nature of this issue. I think nobody will be surprised at what we're referring to as the Amazon effect. I discovered recently that the Amazon has a market capitalization that is about 87.5% of the FTSE 100, and it's actually more than Canada's GDP. And you can just see the most recent surge in Amazon's market capitalization. I mean, it is a remarkable success story, but it has just been turbocharged in this era of COVID-19. And, you know, to give you some broad statistics on why that's happening, although I don't think this will be any great surprise to anybody, this is internet penetration. And I've got here, you can look at this in most countries, but this is the G7, the big seven, the group of 7 economies and the BRICS. And you've probably got 80% of world output in that group. You can just see since 2005 through to 2020, the huge growth of e-commerce in all of those economies. And, you know, contrary to what we might have thought 10 years ago, when this would level off at about 10 to 12% of retail sales, it does not seem to be leveling off at all. Indeed, in most of the big markets, it's forecast to continue to grow. So, you know, the Amazon effect, if we want to put it in those terms, looks set to continue. And Joseph referred to the fact that industrial was you know, it was actually a good performer. It was a good real estate asset even before the era of COVID-19. This is the NACREIF returns in the United States. This is quarterly year-on-year returns. You can see the blue line there is industrial property, you know, more or less keeping pace with all the other asset classes, but also much less volatile than the other asset classes. So the risk-adjusted returns in industrial have always been rather good. But look at that outperformance of industrial real estate since 2016 at the right end of that chart there. So in the even in the era prior to COVID-19, but just that era of a kind of accelerated e-commerce penetration, industrial real estate in the United States and elsewhere around the world has been notably outperforming. And this is just some numbers to back that up. I've got two sources of information here. In the United States, this is the NACREIF, National Council of Real Estate Investment Fiduciaries annual total return data. And in the UK, it is MSCI data. But you can look, I'm just done an average of total return over the various periods. And you can see in the period 1980 to in the United States, 1980 to 1999, industrial was actually the second ranked asset class. And that was kind of long before e-commerce came along. 2000, 2009, you know, it slipped behind a little bit, but 2010 to 2020, it is the top ranked asset class in terms of total return. And in the United Kingdom, we'll just look at those returns there. You know, the period 81 to 99, it was second ranked with an average return of 14.2. 2000 to 2009, again, second ranked. But if you look at the extraordinary returns in the United Kingdom, 2010 to 2019, it's the top ranked real estate asset class. And just a little bit on, you know, let's not get, the Amazon effect, the e-commerce effect is clearly an important driver. But as I said, industrial was always a pretty good asset class relative to other types of industrial. Through most of the 1990s and the 2000s, it had a higher yield than the other asset classes. It always produced, if not spectacular rental growth, at least inflationary rental growth. But the real key, I think, to the success of the asset class was its low depreciation. Most industrial properties are relatively simple in construction relative to office or malls, and most of the value is actually in the land. And therefore, you know, we've noticed as real estate economists for many years that the level of depreciation that you suffer in industrial property relative to other properties, the need for constant capex to remediate and to keep market competitive, it is much lower than in industrial real estate than other sectors. So it just has a whole, you know, bunch of admirable characteristics from an investment perspective. And again, let's just talk about, you know, I mean, let's just talk about where it is now, though. You can see here, I've got, this is a chart I put together. It's a global composite of prime cap rates or yields around the world. And you can see my point that in the earlier period, 2007, 2009, global industrial had a much higher yield than the other asset classes, which combined with low depreciation and rental growth made it just a great performer. Of course, you know, the Amazon effect, although it's given that extraordinary boost to the fundamentals of industrial, it's also drawn, you know, the industrial property to the wider attention of the real estate investing community. And you can just see the way that the cap rate has compressed over the last 10 years. And this is something, you know, that most of us who were real estate investors in the 90s and the early 2000s thought we would never see. But at the end of the period here, you see that prime global cap rates are actually below prime global retail cap rates. So that tells you a little bit about the Amazon effect. Of course, we're in very uncertain economic times right now. I think there's a reasonable global recovery developing. You know, I think a vaccine will be along relatively soon. But, you know, these forecasts of cap rate expansion are a little bit on the downside, I would suggest. That we don't actually have much evidence of a cap rate expansion taking right now. But you normally expect cap rate expansion to take place when fundamentals weaken. In any case, I would take the magnitude of these forecasts a little bit with a pinch of salt. But what I would stand by is that if there is any cap rate expansion in global real estate, you won't notice it in industrial real estate. It is the most defensive sector right now because of the strength of the fundamentals. So, as I said, this just backs up some of the points. This is global volume of industrial transactions. I mean, the success of industrial real estate as an asset class, it's a blessing and a curse. Just makes it more difficult, I think, to acquire good assets. But you can see that investment transactions over the course of this cycle have just gone up and up and up. And my information from the markets around the world is that whereas other sectors are negatively impacted by the COVID-19 shock, we don't think that industrial real estate very much will be, and transaction levels will be at least on a par with the last 2 or 3 years. So it is a very robust and defensive sector. And this is just the same chart, just as a share of overall global real estate investment. And you can see that since 2016, the amount of capital going into industrial real estate has just continued to grow as a share of overall investment. So it really is part of the institutional investment landscape around the world. And I hate to say it as well, just looking at the Preqin data, this is the dry powder. This is the amount of funds that have been raised, which are targeting individual property types. And multifamily remains also kind of very favored by investors. But after multifamily, you've got industrial slightly higher than office. And it is surprising if you, the square footage of office is hugely greater than the square footage of industrial. So the fact that there's more capital queued up for industrial tells you something about the popularity of that sector. And this as well I find very remarkable, and it's just it's the REIT sector, the global REIT sector. And you can see that the COVID-19 shock has caused a shock around all of the markets in all asset classes and all investment types. And other asset class, offices, hotel, retail, are still kind of struggling to bounce back. They've made some recovery since the COVID-19 crisis, but it's just really interesting to me that industrial real estate in the public markets has bounced back very quickly and exceeded its levels prior to the COVID-19 crisis. So, you can look at this from the private market statistics, which I've just shown you, or you can look at it from the public market perspective, but it tells a story of defensiveness and attractiveness and solidity. And again, it's a consequence of some of the trends I've been talking about. This is the industrial investable stock. That's how much industrial investable stock there is around the world. It's tempting to say that supply of product is just a result of increasing values. And of course, increasing values, does boost the dollar value of the overall stock. But I couldn't quite put them together for this presentation, but development trends are pretty strong around the world. So this growth of stock that investors can access is not just a question of more expensive stock. It is the investable universe in square feet is expanding pretty rapidly to accommodate the fundamental demand from e-commerce. So it's hard to see any cracks in the overall investment case for industrial. It's a hot market. There's no getting around it. There's a lot of capital chasing. In fact, that might be the only negative, that it's just so popular with investors around the world. That one has to ask oneself, where do you invest? How do you get into this market? And I think that will come up a little bit more in our discussion later. And this is not really meant to be definitive, but I'll just give you a few thoughts of mine from a global perspective. You know, if you were to look at inventory, and this is the industrial stock by region. You can see that the Americas has the most stock. APAC has actually got a lot of stock as well. EMEA, maybe there is a little bit of a sign that kind of, you know, if you can develop in EMEA, there is still a pretty robust market for industrial assets in EMEA. It looks on the face of it as if there is a bit of catch up in the amount of stock required in the EMEA region. It's always trickier, I think, to develop in the EMEA region than the Americas and APAC, because the land use planning restrictions in that area are kind of more complex and more difficult to negotiate. And to a certain extent, you can see this in the supply of industrial space per capita. Australia got a very high supply of industrial space, Canada, the United States. But you look at Europe, and the supply of space per head of the population is less. So it suggests that if you can involve yourself in development in that EMEA region, it might be a good investment strategy. I also looked at this. I had a quick look at just the forecast growth in e-commerce sales. And I think, you know, the link there is that obviously e-commerce sales is the real driver of fundamentals. And then I had a look at the cap rates, the prime cap rates that are available. And I had the thought that, you know, you want to try and, if you want to try and recapture some of the kind of glory days of retail, of industrial, when you've got high cap rates and also growth, you probably want to go into the markets with high cap rates and high forecast growth rate. And there that you know, throws up markets such as India, Brazil, Italy to a certain extent, and Russia. So I think most investors would probably consider those as not quite core countries, but you know, that's where I think you have to go to really lock into extremely high returns, or historically high returns from industrial. If we look at the liquidity of the sector, and I'm just looking at the number of transactions, then you know that if liquidity is your overriding driver as an investor, then you know it's quite obvious that the Americas is the most liquid industrial market. In fact, it's probably the most liquid of all markets in all asset classes. But it's substantially, the number of transactions relative to the investable stock is higher in the States than elsewhere. So, and I had a quick look at there. I looked at rental growth and cap rates. This is a very quick analysis, you know, with the idea that you probably want to try and locate yourself in markets where you've got higher rental growth and higher cap rate. And I've named a few of those markets there. As you can see, they're not mainline industrial markets, but I think this is what the analysis is telling us. If we really want to lock into those high rates of growth, we perhaps need to take a look at some of the non-core markets, both globally and in the Americas. So just by way of conclusions, COVID-19 has turbocharged e-commerce. I don't think it really needed it, but it has. Industrial real estate has a great track record, even before e-commerce, and some very advantageous investment characteristic. It's an investor favorite now, and so it's seen outsized cap rate compression, which doesn't help. The US has liquidity, and it has some opportunity, and it has low cap rates. Non-core markets tend to have high yields growth, but they're also potentially more risky. And I think Europe has development potential, and probably low risk, but also low cap rates. So that's my presentation. Joseph, back to you.
Thank you, Richard. That was very insightful. We'll move on to our second speaker today, but before we do, look, please do keep questions for Richard coming. These can be typed into the Q&A, which is on the box at the bottom of the screen, and we'll get a chance to discuss these at the end. Our second speaker is Zachary Seferetti. Zachary is the CEO of Dalma Capital. Dalma are an award-winning asset manager and investment bank specializing in alternative investments, including hedge funds, private equity, and real estate. He's also a director of the Man Re Logistics Fund, established in partnership with the Palman Group, the most experienced logistics investor in MENA's leading logistics hub. Following over 30 years of investment in this asset class, Man Re Logistics Fund was established in 2018 to capitalize on elevated performance of this sector in a market where cap rates and fundamentals are superior globally. So Zachary, I will hand over to you to take us through our next presentation.
Thank you so much, Joseph. Thank you so much as well, Richard, for an excellent presentation and leading perfectly into the focus of the discussion that I'm going to be having today. Also, I wanted to give a thank you to our partners at the Palman Group, who are the sponsors of the Man Re REIT and bring the expertise and specialty in investing in this asset class, as well as to the members of my team who helped bring the research together to do this. So just, following on some of the points that Richard discussed, we'll be talking about adding to some of the statistics on why we like this asset class and why we think this region presents the best opportunity in the world for this asset class due to many aspects of the underlying fundamentals that Richard spoke about. The fact that globally we may have some potential risks of crowding effects, a lot of assets, a lot of money chasing this asset class. It's not something that we're seeing yet in the region. It is very much off the radar of the global institutional investors. The yields remain highly attractive. We haven't seen that yield compression and that cap rate compression in other markets. The catching up effect, not only in the asset class, but also in e-commerce in general. And some of the things that actually also make the asset class difficult to access are exaggerated here and require specialized fund managers and specialized expertise in order to execute things like land use as was highlighted. So I'll just be diving right into the presentation. I'll try to keep it short. Again, in the Middle East, REITs are in general quite an underpenetrated asset class, with most of the REITs that do exist in this market being very generalist REITs, having bits and bobs of different commercial, residential, bit of education. And we think now is the time for specialist REITs to emerge that give investors exposure. And that's why, again, our focus has very much been in logistics. Again, we have strong growth expected in warehousing infrastructure. We have a strategic geographic location. We have the rise of e-commerce, which in this region is outpacing much of the rest of the world. E-commerce historically had relatively low penetration, is now having a huge catching up effect in this region, where we are seeing figures that expect to show e-commerce doubling or tripling over the next 3 years, doubling approximately every 20 to 26 months. So around every 2 years, we see a doubling of e-commerce sales and a continuation of the catching up effect here. We have the entry of Amazon into the market. Amazon is relatively new to this region. And a lot of the other parts of the infrastructure, electronic payments and so on and so forth, have really caught up and laid the groundwork. The last mile delivery have laid the groundwork to make this happen. So as you can see here, again, we have e-commerce market growth throughout the GCC. This is remaining at very elevated levels, especially here in the UAE and in Saudi Arabia, which is where we're seeing some of the best opportunities. Actually, for anyone, please keep questions coming in the Q&A for the end of the session, and I will be distributing these slides to anyone through the seminar. So anyone who'd like to access these slides and the data behind them, they will be distributed to you. UAE is a geographic hub for the Middle East, but the Middle East in general has a lot of strong fundamentals as a logistics investment region. The strategic geographic location, the US dollar peg also is considered very favorable for investors. Having that lack of FX risk has obviously been a benefit. We have some of the best transport infrastructure in the world. The UAE is ranked number eight in the world on transport infrastructure, ease of doing business 16th in the world, getting electricity 1st in the world, enforcing contracts 9th in the world, protecting minority investors 13th in the world. So these are a lot of the things that also add to the things that a REIT investor or a real estate investor would benefit from. And Amazon's acquisition of Souk, there's a continued investment in this space that is really on a trajectory that is increasing, and the COVID has only really accelerated. A lot of retailers here in the region that were resistant to implementing e-commerce strategies have now, spent March with 0 sales at their retail stores and realized that they needed to accelerate their implementation of e-commerce and are scrambling to find facilities to be able to do so. The REIT market cap in UAE is low relative to the rest of the world, so there's still plenty of room for growth and expansion. This is global REIT market cap by region. Given that we're low on time, I will kind of skip over that and focus on some of the statistics, just kind of dovetailing into some of the statistics that Richard highlighted. Again, this is total return from March lows and year-to-date return. So we have the return from March lows and year-to-date return. So MENA, as you can see from March lows, in REITs has been the best performer. And if we look at year-to-date, it's actually also coming across as the best performer in the world. So we've seen a strong recovery since our March lows, but we also have strong year-to-date numbers. This is looking at total return from March lows, not only by REIT segment, but also by country. So again, here on the left, we see that data center REITs have been a very strong performer. Now, this is also skewed by some of the low lows that we saw in, for example, hospitality. But as you can see, logistics and industrial has recovered tremendously from the lows in March, and actually it experienced very limited downside compared to other segments. So you'll see in the coming slides that it's actually the best performing asset class year to date. And when we break that down by region, again, here we have logistics and industrial real estate overall coming in as a best performing asset class, and MENA topping that. Now we will concede that the data here are skewed by the fact that we have one REIT skewing the data, but still there is enough fundamental data behind this to demonstrate that it is certainly relevant to draw conclusions. Now we're looking at year-to-date returns across different segments of REITs in general. Again, this is principally public market data. Data center REITs we see as as the top performer, followed very closely by logistics and industrial REITs. As you can imagine, hospitality has seen quite a rough year. Diversified REITs, healthcare has actually suffered. Office, residential, retail. So logistics and industrial is very much at the top of the spectrum. And data centers, as you know, is actually very, very niche space. So logistics, industrial, there's much more opportunity to deploy capital. If we look at this over the last 1, 3, and 5 years, on a country return breakdown for REITs, again, you're seeing MENA consistently outperforming, both market weight cap and simple averages in terms of the performance of regional REITs. And this is, again, highlighted in the logistics and industrial REIT sector. So again, 3 year, 5 years, we're seeing logistics and industrial REITs globally being the best performer, and MENA really standing out from the rest in terms of performance, massively outperforming, and even in, if we look at the 3 year data, outperforming data center and slightly underperforming data center here over the last 5 years. So again, just further compounding and looking at some of the data that Richard presented in a different light, that kind of exaggerates and shows, well, it doesn't exaggerate, but demonstrates and highlights the real outperformance of this asset class and this region. If you look at price to books and valuations, they remain relatively attractive in MENA, which again is, there hasn't been that crowding. There is not over investment in this region. We're not seeing, these eye-watering valuations happening yet in REITs or in the underlying assets. In terms of dividend yields, certainly Africa is coming in at the top of the range, but REITs, publicly listed REITs here have been on the lower end. If again, there isn't enough data to really highlight industrial and logistics, but what you'll see, particularly in our case, is that the yields that we're able to generate are actually only second to Africa in our own fund. But again, the data there are somewhat skewed. Without spending too much time on dividend yield, I'll just go through valuations. As you can see, price to FFO is relatively high in industrial REITs, but that is that's caused by the fact that you've had FFO growth rates of 21%, only falling behind data center REITs. We've had significant underlying performance growth in the FFOs from logistics and industrial REITs. So it is driving that those higher expectations in terms of valuation. In terms of occupancies, again, as you can see, logistics and industrial has since 2010 has been effectively the best performing in terms of increases in occupancy, increases in occupancy rates, going from kind of second to last to first place, demonstrating that there still is more need for supply globally of stock and of high quality stock. The opportunity here in UAE and GCC, again, in the UAE, that is effectively the most established REIT market from a legal perspective, although we still think that there's quite a lot of room to grow, with the number of REITs being relatively low compared to Saudi Arabia, Kuwait, and some of these other markets. And again, our focus is very much on the region, but we see UAE as the key logistics hub, and that's where we are focusing the most. The overall logistics opportunity is again supported by e-commerce growth. In 2018, we saw for every $1 billion of e-commerce sales, we need something around 1.25 million square feet of logistics and real estate just to support that trade growth. So as long as that top line keeps growing, there will continue to be marginal demand, but we do see demand from other sectors in the region continuing to be fairly robust, from engineering, manufacturing, but you'll see that that e-commerce, logistics, distribution is still the lion's share of property demand and where the marginal growth is coming from. For those of you who are not familiar with the GCC, we'll distribute these slides and you can learn more, or I'm happy to have a call with anyone to tell you a little bit more about the different industrial zones here, but I won't bore you with the details, the differences between JAFSA and DIP, but there are nuances to these different zones, to the different free zones that you invest in here, how you hold the properties, what the dynamics are dealing with the free zone authorities. So that's something that the Palman Group has developed an incredible expertise in. They were the first company in JAFSA back in the 1980s, so when it first started. So again, the statistics in terms of the underlying growth trends, in terms of cargo throughput through the different free zones here has continued to remain robust. Again, we see this continuing. there is a huge contribution to regional GDP that's happening through the logistics centers, and it is strategically considered very important. But if you look down here in this window, you'll also see that the industrial rents and well, the yields certainly are the highest in the world. We're looking at these are statistics from CavMax, which are showing yields at approximately 7. I can tell you in the current market, we are seeing very, very attractive deals in the market where we can consistently find 8, 9, 10. Even double-digit yields in properties, and we're talking about high-quality properties with very, very high-quality tenants. And with very robust occupancy levels. So we're seeing again that this region is in many ways, from a fundamental perspective, from a yield perspective, from the underlying market backdrop and dynamics, is the best opportunity really that we know of in the world and that we've been able to see. And the great thing is we're not competing with the Blackstones and the large players that are basically pushing down. I think that they will come. I don't think this region is going to stay off the radar forever. But for one reason or another, I think because of the difficulty in dealing with the nuances of investing here, as well as the fact that I think the region in some ways is misunderstood, it hasn't yet experienced that compression, but we certainly see that coming. So from our perspective, we love this segment, we love this asset class, and we think that the benefits of this asset class are highlighted in the region more than anywhere else. So thank you very much. I'll hand back over to Joseph, who can open up the Q&A.
Zachary, thank you very much for your presentation. That was great. So we'll move into some Q&A now, and please do keep the questions coming. We've got some good ones coming in. Perhaps I'll kick it off by a question to both of you, but maybe starting with Richard. How correlated is the decline in the high street and general physical retailing that we've seen over the last few years with the rise of e-commerce?
I think the correlation is probably nearly 100%. I think goods are either distributed through physical retail, which kind of cluster in the high street and conventional retail, or they're distributed straight to your door through the industrial sector. And over the last 20 years, you've seen that e-commerce penetration, and I know the UK grow from 6 or 7% up to nearly 22%. It's pure trade diversion from the high streets and the smaller centres. America is a little bit slower in that, and America's got 50 or 60 fortress malls, and I think the big retail centres that have been able to offer entertainment and leisure and ever better eating facilities have been able to offset some of that. But the centres that don't have the range and don't have the entertainment are just getting totally competed away by the logistics sector.
And Zachary, in sort of MENA region, which perhaps doesn't have the same high street, but we obviously have a big mall environment here. Do you see sort of e-commerce eating into that sector as well here? I mean, obviously it's not like for like in terms of necessity. People go to the mall for numerous different reasons, but how do you see their sort of e-commerce mall scenario playing out here?
Yeah, absolutely. So, we are seeing a similar dynamic. I think the malls that have gotten the entertainment right, that have gotten the lifestyle right, people go to malls to be with friends, people go to malls to be entertained. They go to the mall as a thing to do rather than as a place to shop per se. So, I mean, obviously there is shopping there, but I can also tell you we work closely with all of the, the retail segment in the region is dominated by a handful of families, right? And I won't say specifically who those families are, but anyone who knows this region will know that there's about a dozen families that control much of the retail. And I can tell you the ones that were quick to and were ahead of the curve on e-commerce, that had good e-commerce platforms and strategies before the crisis, saw the benefit of having that in their portfolio during the crisis and since the crisis, since the advent of the crisis. They have again seen a lot of the loss of trade that they were seeing at the retail branches picked up online, and they've seen their online platforms grow, and they've seen that kind of behavior change that will be persistent on their e-commerce platforms. The ones that have been behind in deploying e-commerce strategies and implementing them are now scrambling to implement them. But I think that we're seeing the kind of the malls that don't have the entertainment offerings, some of the older malls that are not, destinations in and of themselves, those will continue to suffer. Malls are, as Richard said, very much more of a destination for entertainment to go with family and enjoy, rather than necessarily just to shop. So I'd say it's a similar dynamic to the rest of the world, with the exception that I think that the entertainment offering, the malls with strong entertainment offerings like Dubai Mall, like Mall of Emirates, won't be hit as badly as some of their counterparts in other regions.
One thing we're seeing, Joe, just to mention it in the States is, we just put a publication out on it, is the conversion of retail to industrial and last mile delivery. As you might expect, the retail assets, often quite well located to access that last mile and fulfillment of e-commerce orders. So that's an increasing trend, conversion of retail to logistics use.
Absolutely, and actually, I'll expand on that as well. It's not happening to the same degree as in the United States here, but it is starting to happen. And where we're also seeing that is in a segment that we consider part of the logistics real estate landscape, and that is in cloud kitchens. So cloud kitchens to us are part of this logistics infrastructure in a way, this e-commerce infrastructure. And what we're seeing now is conversion of a lot of kitchens or a lot of retail spaces into these cloud kitchens, where you have several operators using these as hubs for delivery, for platforms like Deliveroo, like Kotopi, like these online apps that people are using. And our strategy in that space is, we're very much playing the top line growth of that kind of what we consider to be another type of retail logistics conversion.
Fantastic, thank you. And look, in real estate terms, it was interesting talking about the sort of the different parts of logistics that you define. But look, logistics there's a big bucket there with industrial logistics. You've got manufacturing, etc. When you look at it, Richard, when you break down the sector, is there relative outperformance within that sector? I mean, is everyone about the actual logistics, or how does manufacturing and industrial sit within this? And I'd be interested to hear both of your thoughts on that.
It's a good question, and I have to. I have to confess, I've never done that analysis, but I think I'm pretty close to property returns day in, day out, and actually I don't think I have seen I don't think I've seen a performance differential. There still needs to. The amount of manufacturing activity that actually takes place, industrial real estate is kind of misnamed. The actual making of things that takes place in industrial real estate is relatively minor. In most of the advanced economies, if there is a manufacturing aspect to it, it's a kind of final stage fabricating and a kind of just probably an assembly and distribution type of operation rather than heavy manufacturing. And I think the fact that so much of the industrial stock is being devoted to pure logistics, keeps the supply of the kind of the logistics of the industrial property that is more correctly called industrial property pretty limited. It seems to me that both manufacturing orientated logistics or industrial and logistics orientated industrial are both doing quite well. Would be my answer to that.
Thank you. Zach, one for you that's come in. I mean, it's about the sort of regional dynamics. I mean, you're seeing opportunities obviously in the UAE, but what about markets like Kuwait and Saudi? How do you see opportunities in those markets also?
Yeah, absolutely. So we definitely see opportunities in Kuwait and Saudi. Again, our focus has been the UAE. We look at deals across the GCC, and it just so happens that we are executing deals in the UAE because it's where we are currently seeing the best deals. But there are increasing import and export volumes in the UAE or in Kuwait and in Saudi Arabia. Saudi Arabia is actually experiencing some of the best e-commerce growth. In 2020, actually, Saudi Arabia has outperformed UAE in terms of e-commerce growth. So we're definitely interested in those markets as well. I'd say the one aspect that makes the UAE and Dubai more favorable is some of the liberalization around foreign ownership and around structures for owning and exercising and implementing security over your assets. But those conditions are certainly improved in Saudi. Kuwait also, the government has been making efforts to support the need for additional warehouses and e-commerce assets. One challenge that happened in Saudi Arabia a few years ago related to effectively a land, you can think of it as a land tax that was going to be implemented on unused land. And basically, a lot of people had been granted land and they weren't using it. And they were told, if you don't build something on it, you're going to have to pay a tax on it or face some other penalties. And the cheapest thing sometimes to build was a warehouse. So there was this kind of one-time shock that happened where there suddenly was this oversupply of warehouses where everybody who had unused land and didn't want to be penalized built a warehouse and then thought, okay, find somebody to lease it out. But that was really a one-off shock in Saudi, but I think the market still kind of remembers that, and it has created some hesitation to invest in the asset class as a result. But overall, the fundamentals throughout the GCC are strong. E-commerce growth is outpacing the rest of the world, and Saudi and the UAE are the outstanding markets in that regard.
You both talked about the very obvious positives about the asset class, the sort of undoubted performance that it's had, and the optimistic outlook that we all have for the sector. We've had a question come in. What are the perils for the asset class? What are the potential issues that you may have going forward? Are there any?
Yeah, let me talk about that a little bit. We again, I'll refer to a bit of CBRE research. We've got on our website, just prior to COVID-19, we released a report called Real Estate 2030. I do commend it to everybody, but it sort of slightly got swamped by the news flow as these things tend to. But we looked at industrial, and I think, these are not immediate issues, but you've obviously got to look at automated trucking as a percentile, that just allows trucks to go for longer. It allows the kind of the distribution catchment area of the big hubs to be expanded, and you might see that would somewhat alter the geography of distribution in the big regions like EMEA and the United States where it might be introduced. I mean, we don't see it near term, but the back end of 10 years, you might begin to see automated trucking coming in. I think the whole management of returns from e-commerce is an expensive business. Handling that effectively, you know, puts a lot of stress on the profitability of the logistics operators. Now, I think they're coming up with kind of big data solutions to be able to solve that, more about predictive distribution. But nevertheless, it's not cheap to handle the volume of returns from e-commerce. And there is something, I think, as well, just about the whole, you know, as you know, anybody who lives in the States, every apartment block you go into has got a mound of cardboard boxes, you know, when you walk into it. There's something just about the sustainability of e-commerce. I don't mean in the narrow sense, because it's clearly growing very rapidly, but I think the kind of the resource usage that might bite back. And you know, on top of that, you've got to watch out for trade wars and changing patterns of trade. And again, we've just CBRE's just put out a big global report on the changing port usage of manufacturing activity shifting out of China into other locations. You know, which ports does that favor? Which industrial hubs does that favor? I think you've got to watch out for. These are not negatives; they're just things to watch out for. And of course, any trend in the United States towards nearshoring, you know, within the NAFTA region rather than production in Asia, is going to favor production in Mexico. It's going to favor some of the inland ports and distribution hubs in the United States. So I've talked a bit about the United States because I'm familiar with it. But, you know, nothing, you know, you know, we're investors. Let's not believe our own rhetoric here. Industrial real estate is great, but you've got to just always try and find, you know, keep your eyes, you know, on some of the shifting and changing, you know, dynamics of distribution.
Fantastic. And another question come in regarding yield compression of the space. Obviously, we've kind of closed the gap between the historic gap between office and industrial quite significantly in terms of prime yields. What drove the spread in the past, and what is a reasonable relationship of industrial versus office yield going forward?
Well, I mean, I think one of the things...
Do they have to be related? I mean, what would you...
Well, I mean, you know, I don't know that they necessarily do, really. I think that, you know, investors really compare assets with the bond, you know, the long-term bond, really, and think of a spread. I mean, I think the thing that drove the spread in the past was, you know, you typically had, you know, and it's what we talked about earlier, it was low-level manufacturing driven. So you had, you know, an industrial sector that had quite a lot of small companies undertaking on short leases, undertaking kind of, you know, rather oily or messy kind of manufacturing type activities. And I think, although the sector was always highly cash generative, it didn't have, you know, you didn't have the kind of 10-year lease to a kind of prime grade tenant. But of course, you know, with the rise of e-commerce and the rise of the 3PLs, you know, the third-party logistics operators, and you actually got some good covenants behind, you know, the occupation, and just the solid fundamentals of the growth of e-commerce. That has made the compression. So, and you've got to say, you know, you've got to price that spread between the cap rate and the bond rate, you know, for any risks. And I think objectively, a lot of the risks, you know, associated with prime and even non-prime industrial real estate, such as they used to exist, have disappeared with a new pattern of occupation. Sorry, long answer, but I don't think, you know, I could even see cap rates in industrial trending down to office levels.
Yeah, I would argue the same, and possibly even below. Again, you know, looking at, you know, anybody would like to be long Amazon, you know, Amazon credit risk, right? Or a privileged credit risk. the characteristics of the asset, the other characteristics of the asset class give me no reason to believe that it shouldn't that spread shouldn't tighten and again, come in line with office or potentially better. So I would certainly agree with Richard on that. And given so I don't see any reason for that trend not continuing in the future.
And staying on cap rates at the moment, and talking about where we're obviously at all-time lows in cap rates. I remember when I started my career, rental growth in logistics was never something you really spoke about. Perhaps for the first 15 years of my career, we didn't really see any at all. It was a sort of a flat yield, and hence why yields were fairly high in the sector. Are people coming into the sector now taking depressed yields, expecting future rental growth? How much is rental growth driving compressed cap rates versus just the weight of money?
Well, I mean, I think, it's all of the above. I mean, there are, we've just redone our US forecasts for rental growth, and not surprisingly, industrial leads the pack, barely breaking step in COVID-19. So, undoubtedly that kind of rental growth coming out of, the growth of e-commerce. And there actually, the relative, there's a thing that we don't speak about as well, which is particularly in the developed world, there's a natural supply constraint as well. It's difficult, to get sites for last mile delivery. So that's a natural constraint. And actually, the big 1 million square foot distribution hubs, even in the United States, it's actually quite difficult to find land to build those big hubs. So you've got the rental growth coming out of fundamental demand, but you've also got a natural supply constraint. And of course, as we said earlier, you've got the improvement in the covenants in the sector. So it's not just rental growth, there are other factors. And of course, the fact that the central bank is pumping more, central banks around the world are, creating money that has to go somewhere. That's a kind of, another kind of aspect to it, but that doesn't affect only industrial. That affects the whole of real estate asset cap rates.
Yeah, and I would completely agree with Richard. I'd say a lot of that is supply side. You asked earlier about some of the risks as well in the space. I mean, I think it is risky going to the space not having. You need to have high quality assets. Amazon, 3PL providers, they want their facilities with a certain spec. They want the loading bay doors a certain size and a certain distance apart and certain ceiling heights that help them operate that space as efficiently as possible with their equipment. So these are so that plays into the supply side. Another dynamic that I think is exaggerated here in the UAE is, anybody in the real estate business has had plenty of starry-eyed real estate developers coming in front of them with, glamorous presentations and projects. And, there's a lot of projects get funded here, especially here in the region that, may be providing too much supply to other segments of the real estate market. And that's not the case in logistics. It's not, it's the fact that it is unsexy is actually one of the other key benefits for investors, because at the end of the day, if hard-nosed investors who are looking for, a good bottom line and a good return, an unsexy, relatively, boring segment of the market also keeps out a lot of kind of developers looking to, plaster their names on beautiful developments. If you go to these cityscape conferences, all these little, mock-ups and whatnot, how many of those are of warehouses? So I think that, we can't forget that dynamic as well. But I do think not only is it driven by demand side being favorable, but supply side, creating conditions that mean that it is, there are some natural constraints to developing in the asset class, and there are only so many developers that have the expertise to be able to deploy within it.
I think we're coming up to time, but I think we'll try and squeeze a few more questions in if you both are happy with that. Look, one question is, I see Amazon as a retailer. Retailers are supported by a supply chain of companies wishing to sell to the retail population that historically have used their warehouses or third-party warehouses to position their product for entry into the retailer's distribution centers. How will this change with Amazon? Is there any difference between dry goods versus perishable goods, including frozen? Any response to that from yourselves?
I mean, I can tackle the last part of that question. I mean, there is clearly a big difference between dry goods and frozen goods. In fact, one of the big trends, and this is at the forefront of logistics around the world, really, the penetration into e-commerce of grocery. And so you need, logistics that are kind of have got levels of refrigeration within them. It's a very technical area of real estate investing. The kit is quite expensive. There is this joke wasn't funny when I first said it, and it isn't funny now, but it's the hottest area. Refrigerated logistics is the hottest area of, within logistics. Accessing the product is difficult. There is not enough of it. There are not enough developers who know how to do it properly. There are location constraints. Needs to be close to the market. Needs to be highly technical. So that is a growth area within the logistics market. I'm not sure. You probably have to repeat to me. Maybe Zachary can take over the first half of the question.
Retailers are supported by a supply chain of companies wishing to sell to the retail population using third-party warehouses to position their product for entry into distribution centers. Does Amazon change that model?
Well, I think. Sorry. I think it's important to remember that Amazon is not just a retailer. Amazon is a platform for retailers, right? Amazon is in many ways more of a platform business than a retail. I mean, they also are a powerhouse in retail. They compete with their own customers. But remember, anyone can become a merchant on Amazon, and Amazon is an important part of the infrastructure, and other 3PL providers are an important part of the infrastructure for providing retailers the capability to change the way they engage with their customers through retail centers. If we're talking about kind of the marginalization of the wholesaler, it's that inventory is still sitting somewhere, right? And the fact that it's not sitting, I think the important thing is you have to think of when e-commerce is replacing retail for sales. That T-shirt that you would have bought, or that TV, instead of sitting in a store, is sitting in a warehouse waiting for you to buy it. But it still has to sit somewhere. Yes, it can occupy a more dense space in a warehouse than it can in a shop or in a store. But I think that's the important thing to remember on retail. I'm not sure if I'm answering or fully understand or answering the question correctly, but those are some of the dynamics that I think are important to highlight. But over to Richard, I think he had another point.
Yeah, no, I think you answered it. Amazon itself is a platform for other retailers. I think one of the interesting trends itself actually is that Amazon has been, trying to gain a physical presence. So that's kind of one area that you see that kind of the retail aspect of Amazon. It's not just about logistics. And I think from our perspective, another interesting angle on it that we won't probably explore here is just how many of the retailers that take part in the platform that Amazon provides actually then take a physical presence. So, you know, we don't see, it's not wholly one-way traffic of goods from the high street or from the shops into the cloud or into the e-commerce sector. We actually do see a flow of new retail concepts coming out of Amazon and then taking space in kind of the more dynamic retail areas as well. But I think for all of the big platforms, it's really, you know, there's still a job to be done in terms of last mile fulfillment. You know, just get that same day delivery. That's really what everybody's after. And you need a very, very tight logistics operation with really, you know, smaller, super efficient last mile facilities for that.
And look, just on that very last question, just trying to squeeze one last one in. Look, in terms of property characteristics, is there an optimal format, location from a market, optimal size, nature of facility? So perhaps just a quick comment on that, sort of last mile versus hub. Where would you be putting your money at the moment?
Zach's a professional investor, so I'll hand that one to him.
Well, yeah, I mean, we really like JAFSA, we really like DIP here in the UAE. These are excellent free zones with great access, great infrastructure. But yeah, it needs to, for us, especially right now, because there are way more deals than we can do. Every deal that we're doing right now has to tick all the boxes, right? It has to have the perfect location. It has to have the perfect infrastructure. It has to have the, you know, again, everything that we need, the right tenant or the right tenant available from our portfolio of tenants. It is very much a buyer's market more than ever has been here. So you know, it's a great time to be very differentiating. Unfortunately, we have far more deals that we'd like to do than we have capital to deploy into. But it means that we're also very highly selective in the deals that we ultimately do close on. So for us, it really needs to tick every box for us to pull the trigger.
Darcy, well, look,
okay.
Well, sorry, Karen, Richard, we'll have a last comment from you.
Yeah, no, I think I would be looking at the big box centers. It's a very dynamic sector, and let's not kid ourselves. You've got to be, normal care and attention to your investment. But I'd be looking at big boxes on the periphery of the big population centers. On the basis that most of the 3PL type activities kind of hub and spoke. So that's what I would be looking at, particularly the dynamic, the growing urban centers.
Fantastic. Well, look, thank you very much, both of you, for your insight. It's clear logistics is a sector exceptionally placed for continued outperformance. We've got through a lot today, looked at historic performance, fundamentals, capital flows into the sector, region versus global markets. So covered a huge amount of ground in quite a short space of time. And I hope this was a useful session to all those viewing. The AIM Summit will be live next Tuesday with Nouriel Roubini, Tuesday 8th of September at 4 p.m. Gulf Standard Time, where he'll be discussing the short-term and medium-term outlook for the global economy, an anemic U-shaped recovery or a V-shaped strong recovery or a W-shaped double-dip recession. Visit the AIM Summit website or to register for the webinar. So thank you once again to Zachary Seferetti from Dalma Capital. Thank you to Dr. Richard Barkham from CBRE, and thank you to Manri Logistics Fund for sponsoring. And thanks to all of you who logged on today.